Welcome to The Recipe for Wealth, Mastering Asset Allocation. The master ingredient to investing isn't picking the perfect stock, it's how you mix your investments. The biggest secret in investing is this: financial professionals agree that how you divide your money across different investments is the single most important decision you make. Selecting individual securities is secondary. Asset allocation is the process of dividing your investment portfolio among different asset classes. It's like a balanced diet. Your portfolio needs the right mix of assets to balance risk and reward. The three core ingredients are equities or stocks, which offer massive growth potential, fixed income or bonds, which provide stability and consistency, and cash and equivalents, offering absolute safety for short-term needs. The golden rule of investing is that high reward always requires accepting higher risk. Each asset class has different risks and return potentials, so there is no simple, universal formula. Your personal recipe is built on three pillars: your financial goals, your time horizon, and your risk tolerance. These factors determine the right mix for you. Scenario 1. Saving for a new car next year means a short-term, conservative strategy. Your money needs safety, so a high allocation to cash and bonds is recommended to avoid short-term market crashes. Scenario 2. Saving for retirement, decades away, calls for an aggressive, growth-focused strategy. A high allocation to stocks allows you to ride out short-term fluctuations and capture massive long-term growth. A classic rule of thumb for stock allocation is 100 minus your age. However, due to growing life expectancies, many advisors now recommend subtracting your age from 110 or 120. Adjust your allocation for the seasons of the market. In summer or bull markets, lean into growth-oriented assets like stocks. In winter or recessions, shift towards protective investments like bonds and cash. If you don't want to cook from scratch, consider target date funds. These mutual funds provide a pre-mixed, diversified portfolio tailored to your specific retirement year, automatically addressing your needs in one package. Target date funds use a glide path strategy. This means the fund automatically reduces risk by shifting from stocks to bonds as you near your target retirement date, preserving your nest egg. Beware of cognitive errors that can ruin good financial choices. The chef's worst enemy is often themselves. Avoid chasing trends, overconfidence, loss aversion, and sunk cost reasoning. To start today, first define your timeline, then check your spice level or risk tolerance. Finally, pick your method: DIY, using the 100 minus age rule, or use a target date fund meal kit. The bottom line is that perfection isn't required. Participation and balance are. Deciding how to allocate across stocks, bonds, and cash will ultimately drive your investment results. Keep a disciplined, long-term approach.